Chapter 7 deals with large corporate transactions. Now we're going to talk in this video about essentially different types of mergers. Types A, B, and C. You'll see why we call them types A, B, and C in just a moment. First, corporate reorganizations are, as I said, large, infrequent transactions that alter some aspect of how the business is structured. So we're going to be making structural changes to our corporations with these transactions. Not the sort of thing you do every day. We're not selling goods and services here, which you expect you're going to do every day you're open for business. Here, infrequent. You're not going to do this very often. Many corporations will never do them. But if you do, it'll be infrequent. So examples would include mergers and acquisitions, and that's going to be the focus particularly of this video. Also, division. Take one corporation, split it up into multiple parts. Restructurings, where you change something fundamental about the capital structure of a particular corporation. And then we also have some insolvency and bankruptcy related transactions that could also be considered in here. Transactions may be structured as taxable or tax-free reorganizations. Now we're going to focus on the tax-free, but you can accomplish most of these things also through taxable transactions. And then it's just a question of whether you want it to be taxable or not, whether you're going to structure it to meet the requirements for a tax-free reorganization, or you might choose not to. You'll find out what the consequences are, and then you can make your choice. If the transaction qualifies as a tax-free organization, then we can say in general, without knowing the specifics of the transactions, that generally this is what's going to happen. No gain or loss is going to be recognized by a corporation issuing securities to acquire assets. No gain or loss is going to be recognized by a corporation that transfers the assets in the transaction. And no gain or loss is going to be recognized by the stockholders who receive stock in exchange for their stock. Those are the general rules. As you know, there will always be exceptions of various types. For the transaction to qualify as a tax-free reorganization, it must meet the definition of one of the following 7 types. Type A, statutory merger or consolidation. We'll go into the details of what these all are in a moment. But right now, here are the quick descriptions of the 7 types. B, stock for voting stock. C, asset for stock. D, transfer of assets to a controlled corporation. The E is a recapitalization. F, change in form or identity. And the G, insolvency reorganization. Those are your 7 types. Now go back to that first slide we had where we talked about corporate reorganizations, large infrequent transactions, and the examples include those 4 different types of examples. Well, now we can put letters next to them. Mergers and acquisitions, A, B, and C, which we're covering in this video, and some type D reorganizations will also end up as a merger or acquisition. A corporate division, if it's going to be a tax-free transaction, it must be a D. So a D could combine 2 corporations into one, or take one corporation and divide it up into separate pieces. We'll see that when we look at the next video, type D reorganizations. But if you want to do a division, you want to split up a corporation into parts, and you want to do it tax-free, D is your only choice. Restructurings within a particular corporation. You start out with one corporation, you end up with one corporation, you change something fundamental about that corporation, but you're not combining or splitting corporate entities. And then finally, insolvency and bankruptcy transactions, that's the G. Okay, so we have those 7 types. We're going to look at A, B, and C in detail in this video, and then we'll do D, E, F, and G in the next video. In addition to the statutory requirements, which we'll cover, reorganizations also have to satisfy some judicial conditions. Courts have said, yeah, okay, maybe you met the letter of the law for A or B or C or whatever it is, but you got to meet these requirements as well before you have a tax-free reorganization. Sound business purpose. Transaction must have a purpose other than just some sort of a scheme to avoid tax. Got to be some reason for you doing what you're doing other than our tax bill will go down. Continuity of business enterprise. So the transaction cannot be just a liquidation. If you want to do a liquidation, do a liquidation. That's a taxable transaction. Can't use a tax-free reorganization to liquidate an entire corporation. And continuity of interest. That means that some of the owners of the original entity must end up as owners after the event. So if you acquire a corporation and none of the stockholders of the corporation you just acquired are now stockholders of your combined entity, you have failed the continuity of interest requirement. Type A, statutory merger or consolidation. The requirements to qualify for a Type A reorganization are quite loose. One corporation is dissolved into another corporation and meet the requirements of state and corporation law. A merger happens when one corporation is acquired by another corporation and perhaps dissolved into that corporation. A consolidation happens when a newly formed corporation acquires two or more existing corporations. Merger of T into A. T is the target, A is the acquirer. So there's corporation A, there's corporation T. A wants to acquire T. So how are we going to do it? A issues stock to T stockholders for all of their T shares. Then A liquidates target T. And we have a single corporation with the T assets and the A assets combined under a single corporate shell. You say, well, wait a minute, I didn't want to actually liquidate T. I just wanted it as a subsidiary. You can do that too. Triangular merger, A and T are there. A forms a new subsidiary. Now this is just a brand newly formed subsidiary with no assets. And then it transfers some A stock into the subsidiary. So now the subsidiary has A stock. That's its only asset. And in exchange, the subsidiary transfers its stock back to A. A is now the sole stockholder of new. Then subsidiary transfers the A stock to the T stockholders for all of the T shares and liquidates T into itself. So now we have A with its subsidiary new, but new has nothing but the old T assets. So basically it's just T as a subsidiary of A. That's still a Type A merger, but now in this case, A has a subsidiary instead of combining the T assets with its own A assets. So you can do it either way. You can wind up with whichever result suits your business purpose the best. You can also have a consolidation where you have two, instead of A and T, we'll do A and B, two equals. Consolidation of A and B happens when we form a new corporation. And the new corporation is formed which issues stock to the A stockholders and the B stockholders in exchange for all of the A and B shares. Then the new corporation may or may not liquidate A and B. If it does, then you'll have just the A assets and the B assets inside a single corporate shell. If it doesn't, you would have new as a holding company with no real assets of its own other than A shares and B shares. And the operating assets would still reside in the subsidiaries A and B. Now, the types of consideration allowed in a Type A merger could be stock, could be cash, could be debt, could be any other property. In other words, basically anything is allowed in a Type A merger. Whatever state law allows, you can do it. But There's the continuity of interest rule. Remember, don't forget the continuity of interest rule. Some of the consideration must be stock because the T stockholders have to wind up, at least some of the T stockholders have to wind up as A stockholders, or continuity of interest requirement is not met. So how much? Can you just give one T stockholder some A shares and call it good? Probably not. We don't know exactly how much, but we do know there's a safe harbor. If 50% of all the consideration paid to the T stockholders is in the form of A stock, then the IRS says you do 50% or more, you're good. Continuity of interest is met. We will not challenge this on the grounds of continuity of interest. So there's your safe harbor. It's just a safe harbor. You go 50% or more, you know you're good. Can you do 49.9%? Yes, you can, but you're outside the safe harbor. I have read many documents that say you must have at least 50% of consideration as stock. That is not technically true, but I understand why the author said it. These could be multi-billion-dollar transactions. You really want to take a chance by going to 49.5% of the consideration as stock? And a multi-billion-dollar transaction that is either tax-free the way you want it or taxable and going to cost stockholders and your corporation and others many millions and billions of dollars? No, you're not going to take that chance. So it makes sense for the authors to write you must have at least 50% of your consideration in the form of stock. Even though that's not technically true, you should probably treat it as if it is technically true. Type B, stock for voting stock. As loose as A is, B is extremely tight. It's an acquisition of stock of one corporation solely for voting stock of the acquiring corporation or its parent. Requirements: the acquirer must control immediately after the acquisition 80%. Remember, control in tax speak, not this 50% plus one share, 80%. Control at least 80% of the voting power plus 80% of each class of non-voting shares, if there are any. And the acquisition must be solely for the voting stock of the acquirer or its parent, but not both. So you can use one or the other, but not both. So here's A and T. A issues stock to the T stockholders in exchange for T shares. And we have A holding its subsidiary T. We saw how to get that result with a type A using a triangular merger, but a type B will get you there directly. Or you can use a subsidiary. Remember, we said we could use the stock of the acquirer or its parent. So A issues new shares to its subsidiary S. So now S has A shares. And then S transfers the new A shares to the T stockholders in exchange for the T shares. Then T may or may not be liquidated into the sub. If it's not, you wind up with A as the parent of S and S as the parent of T. Or you could liquidate T into S and then A is just the parent of the combined S and T subsidiary. Either one will qualify. But the stock for voting stock requirement, solely for voting stock, means literally that. If there are minority dissenting shares, so 2% of the B stockholders say, we don't want to do this merger. We're going to sue and tie this whole thing up in court for a year. The target could say, look, let us buy you out. And we'll give you cash for your shares, and you can go away, and we can do our merger in peace. That is allowed, and that will not violate the type B. The acquirer cannot. That would violate the solely for voting stock requirement. No, you bought those shares for cash. That's not voting stock, so you can't buy those shares for cash. Target can, acquirer cannot. You cannot do a hostile type B takeover. You can do a type A as a hostile takeover, but No, a B, it's not going to work. There are too many things that the target, if they don't want this to happen, can do to trip up your plans. This got to be a cooperative engagement here. Other target securities may be acquired for cash or debt or stock. So if the target has outstanding bonds and you want to retire those bonds, you can use stock or debt or cash or anything. That's fine. The stock, though, must be acquired for stock. Acquire is allowed. This is the one exception, a very narrow exception to the stock for stock requirement. If the target shareholder would get 200.3 shares of the acquirer for its target shares, and the acquirer doesn't want to issue fractional shares, it can pay cash for those fractional shares, but that's the only very narrow exception to the stock for voting stock rule. Type C, assets for stock. So we're not going to buy the other corporation's stock. We're just going to go in and buy the assets of the other corporation. We're going to acquire substantially all of the properties of one corporation in exchange for voting stock of the acquirer, or again, it's of the acquirer or its parent. Requirements: the acquirer must acquire substantially all of the target's assets. Now that wiggle room is there with that word substantially. It does not have to be 100% of the target's assets. It must be for voting stock, but you can have a limited amount of boot. So it's not the solely for voting stock rule that we had in the Type B. And the target must liquidate at the end. So here's the acquirer, here's the target. A issues stock to T, not to the T stockholders, but to T for substantially all of T's assets. Then T liquidates and distributes the A stock to its stockholders. So you wind up with the T assets included in the corporate structure of the A assets. Substantially all does give you some wiggle room, but it does mean there's got to be enough transfer to the acquirer so that there is not a viable self-contained business remaining with the target. We're talking about leaving only something that may be transferred to the target shareholders or maybe just remain within the target, but it's not enough to actually have a viable business. Qualified consideration: at least 80% of the value of all the assets must be acquired for stock, but that means that up to 20% of the asset value may be acquired for boot, cash, or bonds, or something other than stock. Now, the assumption of the target's liabilities, that counts as boot. So you say, well, wait a minute now, that means if the target's debt equity ratio is such that the liabilities are greater than 20% of the asset value, that I can't do a Type C? No, not necessarily, because that boot will be disregarded if no other boot is paid. So watch out. Don't just think, okay, 20% I can use cash or something. If you're acquiring the target's liabilities, check those out first. How much do they have in liabilities? And if you assume the target's liabilities, you may not have any room for payment of other boot. The target must liquidate, as we said before. Once again, you could take the assets into the target itself, which was the diagram we showed, or the acquirer could form a subsidiary and you could liquidate the target into the subsidiary. So you're still holding it as a sub. That is also allowed. Remember, you can use the stock of the acquirer or its parent. If you want to have that with a parent-subsidiary relationship, you can still do it. The tax consequences of these acquisitive tax-free reorganizations, now that we've seen the details of the A, B, and C and kind of seen how they come together, we can come back to look at the tax consequences where we were just very general originally when we described them. Now we can be a bit more specific for these three. For the acquiring corporation, no gain or loss is recognized. The basis of the assets acquired is transferor's basis, plus the unusual case where you have a gain recognized by the transferor. Now, that is generally speaking going to be the target corporation. Next, the target corporation, no gain or loss is recognized unless boot is received and not distributed. So boot received by the target that is distributed to the target shareholders, the target will not recognize gain on the basis of boot received if it distributes it. If it receives the boot and retains it, which is going to be fairly unusual, then it may have to recognize gain up to fair market value of boot received. And that would add to the basis of the acquiring corporation's assets that it just acquired. But again, fairly rare to add gain recognized by transferor to the basis of the assets acquired. So almost always it's just going to be transferor's basis. And the target corporation only very rarely will have to recognize any gain. Target stockholders, on the other hand, no gain or loss is recognized unless boot is received. And of course, in an A where, well, slightly less than 50%, technically more than 50% if you want to be risky, but nobody does with these big transactions, could be boot. And in a C, there could also be boot going to the target stockholders as long as the target corporation doesn't have a huge amount of debt. You could also have boot there. So there could be recognition of gain, not so much in a B, but the A and the C, definitely a possibility. And of course, same rule as always, if you receive boot, recognize gain up to fair market value of boot received. Take a look at problem number 25 from Chapter 7. Quail Corporation was created 6 years ago through contributions from Kasha, contributed $900,000, and Frank contributed $100,000. So Kasha looks like she's a 90% shareholder and Frank is a 10% shareholder. In a transaction qualifying as a reorganization, they don't bother telling us A, B, or C. Quail exchanges all of its assets, currently valued at $1,800,000, basis is $1,200,000, for Covey Corporation stock valued at $1,700,000 plus $100,000 in Covey bonds. This sounds like it's probably a C. It could possibly be an A. Definitely not a B. Quail distributes the Covey stock and bonds proportionally to Frank and Kasha in exchange for their stock in Quail. Quail's current and accumulated E&P before the reorganization amounts to $70,000. We haven't dealt with what do you do with E&P. We will talk about that actually in the third Chapter 7 video. But we really don't need to know very much about E&P to answer these questions anyway. So letter A, how do Kasha and Frank treat this transaction for tax purposes? What is Kasha's and Frank's basis in their Covey stock? Then it says, prepare your solution using spreadsheet software such as Microsoft Excel. Fine, you can set this up as an Excel spreadsheet if you want. We'll just talk about what the answers are. So Kasha got stock worth $1,530,000. She also got bonds of $90,000. I'm assuming Kasha is female. They don't actually say. Total consideration, $1,620,000. And her basis is $900,000 in the Quail Corporation stock. So realized gain, $720,000. And the recognized gain, up to fair market value of boot received. The bonds are boot. So $90,000 is Kasha's recognized gain. Frank, $170,000 of stock. That's 10% of the $1,700,000 in stock that is being transferred. and 10,000, 10% of the 100,000 in bonds. That is a total of $180,000 amount realized. Frank's basis is $100,000. Frank has an $80,000 realized gain and a $10,000 recognized gain, once again, up to fair market value of boot received. Continuing with letter A, the basis of the Covey shares for Kasha, fair market value $1,530,000. The deferred gain is $630,000. Remember that she's recognizing a gain equal to the amount of the bonds received of $90,000. So the rest of her gain is deferred. So her basis is $900,000. Once again, we've seen it over and over and over again. Basis of the new equals basis of the old. For Frank, fair market value of the shares received, $170,000. His deferred gain, $70,000. Remember, he had a total $80,000 gain, but he had to recognize 10 of it. So the other 70 not recognized. Subtract that out, and you get a basis of $100,000. And for Frank, same as for Kasha, basis of the new equals basis of the old. Letter B. How did Quayle and Covey treat this transaction for tax purposes, and what is Covey's basis in the asset it receives from Quayle? So Quayle, no gain recognized. Also for Covey, no gain recognized. And the basis of the assets will be Quayle's basis, which is $1,200,000. And there is no adjustment to Quayle's basis. There's no need to adjust that because there is no boot retained by Quayle that caused Quayle to recognize a gain. Frank and Kasha recognize gains, but not Quayle. Problem 26. Jed acquired 25% of the stock of Alpha 12 years ago for $100,000. The other 75% was purchased by Manny 3 years ago. Manny's basis is $400,000. Alpha enters a tax-free consolidation with Beta, in which Jed will receive an 8% interest in the new Alpha Beta. That's a value of $90,000, and also Jed will receive $36,000 in cash. Manny will receive a 28% interest valued at $315,000 plus land worth $63,000. Alpha's basis in that land is $35,000. Before the reorganization or distributions to shareholders, Alpha's value is $504,000. Beta's value is $720,000. What is Jed and Manny's recognized gain or loss on this reorganization, and what is each shareholder's basis in their Alpha Beta stock? And once again, they say use Microsoft Excel. Fine, use Microsoft Excel if you want. Pencil and paper is also very good, though. So, Jed, amount realized in stock, $90,000, and cash, $36,000. The total amount realized is $126,000. Jed's basis in the stock is $100,000. So Jed has a realized gain of $26,000. Jed is going to have to recognize gain up to fair market value of boot received. Well, $36,000 of cash was received. So we'll recognize that whole $26,000 gain. I always remind students that don't just look at the boot and say, oh, I've got to recognize that as gain. Sometimes the realized gain is less than the amount of boot received. This is a case. So you're never going to have to recognize more gain than you realized. So $26,000 it is. For Manny, $315,000 worth of stock, and now you'll see why I left a blank space there. That's for the land. $63,000 in land. Total $378,000. Manny's basis was $400,000. Uh-oh, Manny has a loss of $22,000. Recognize loss, recognize gain up to fair market value of boot received. Do not recognize loss. So Manny does not get to recognize that loss. Continuing with letter A, they said the next question is, what is the basis of the alpha beta shares? For Jed, fair market value is 90,000. We'll adjust that for, well, nothing, because the entire gain was recognized. So no adjustment. Basis is 90,000. Just as if he bought all those shares for cash. For Manny, fair market value of the shares that Manny received is 315,000. Manny had a deferred loss. Deferred gain, you have to subtract from your basis. Deferred loss, you get to add to your basis. He'd probably rather get to deduct the loss, but can't do that. So, but at least you get to add it to basis. So his basis in the shares is $337,000. Letter B, what is alpha and beta's recognized gain or loss on the transaction? Alpha's gain, well, the land had a fair market value of $63,000. The basis to alpha of that land was $35,000. That land was distributed to Manny, and so alpha is going to have to recognize a $28,000 gain. Beta, by the way, had no recognized gain or loss. It did not distribute any assets to its shareholders, so it has no gain or loss. Letter C, draft a detailed diagram for the consolidation of alpha and beta. The first thing I did after I read that was to go to the solution manual and say, well, what did they do? And I looked at that diagram. I said, ugh, that's way too many moving parts. I didn't like their diagram. So therefore, I went back to the diagrams we did before in this video. We have alpha and beta, and we're going to do a consolidation of alpha and beta by forming a new corporation called Alpha Beta. And then it issues stock, alpha and beta stockholders for all of their alpha and beta shares. It also issues some other stuff to the alpha and beta stockholders. But that's fine. It's allowed. And then the new corporation liquidates alpha and beta. And we have alpha beta with the remaining assets of alpha and beta. By the way, that liquidation had to happen before alpha beta had any land to give to Manny and Jed. But that's fine. Said I'll owe it to you, and then when it got the assets, it was able to then transfer them. So there you go. There's our diagram. Looks very much like the diagram we had earlier in this video, because that's what I did. I stole that diagram and changed the names to alpha, beta, and alpha beta. Okay, problem number 27. Target Corporation holds assets with a fair market value of $4 million, basis $2,200,000, liabilities of $1,005,000. It transfers assets worth $3,700,000, so not all of them. There's another $300,000 in asset value unaccounted for here. Transfers them to acquiring corporation in a Type C reorganization in exchange for acquiring voting stock, the assumption of $1,004,000 of target liabilities. Target retained a building worth $300,000, adjusted basis $225,000. So there's the difference between the $4 million in total assets and the $3,700,000 in assets transferred in the reorganization. Target distributed the acquiring voting stock and the building plus a $100,000 mortgage to Wei, the sole shareholder, for all of her stock in Target. Wei's basis in her stock is $2,100,000. Prepare your solution again using Microsoft. We'll skip the Microsoft part. Microsoft Excel. We'll do it in Microsoft PowerPoint. Okay. Explain whether the transaction meets the requirement of a Type C reorganization. Well, the target's assets to acquiring $3,700,000 and to Wei $300,000. Liabilities $1,004,000 and $100,000 to Wei. So net assets $2,300,000 and $200,000 The transaction qualifies as a Type C reorganization because acquiring corporation got more than 90% of the gross assets and more than 70% of the net assets. Way did not get an active business. She got a building, which does not by itself constitute, in most cases, an active business. Letter B. What is the value of the stock transferred from acquiring to Target? Acquiring stock transferred to Target is worth $2,300,000. We figured that out up above. Letter C. What is the amount of gain or loss recognized by Way, Target, and acquiring on the reorganization? Well, Way had stock of $2,300,000, also got a building worth $300,000, subject to a mortgage of $100,000. So the total amount realized is $2,500,000. Way's basis in the stock, $2,100,000. So the realized gain is $400,000. The recognized gain, Way is going to recognize gain up to fair market value of boot received. Boot received is that building net of the attached mortgage, or $200,000. So Way will have to recognize a $200,000 gain. Target distributed the building worth $300,000. Target's basis in that building was $225,000. So therefore, Target had a gain on the distribution to Way of $75,000. Finally, letter D. What is Way's basis in the stock and the building that she received? Way's basis in acquiring stock is her basis in the Target stock, increased by the gain recognized and decreased by the fair market value of boot received. So that's $2,100,000 plus her gain recognized of $200,000 minus fair market value of boot received of $200,000 equals $2,100,000. Basis of the new equals basis of the old, as it so frequently does. Way's basis in the building is its fair market value, $300,000. And that concludes our first discussion of the tax-free reorganizations types A, B, and C. We will do D, E, F, and G next.